All right. So hi, everyone. Welcome to our first Defunding Climate Disaster / Fossil-Free PERA committee meeting of the year. I'm so excited to see you all, and I am so excited to have a very special presentation by Corporate Knights. We have Toby Heaps and Michael Yao here. As well as former Senator Mike Foote, who we're working with on our legislative efforts. So just quickly to go over the agenda. So I just did a quick introduction of speakers. We're going to do a quick introduction of the report, and then the top line item that everyone's here for, the presentation by Corporate Knights on the new study, which found that in the last 10 years, PERA has lost $2.7 billion by not divesting from fossil fuels in the last 10 years. So digging into the results of that study and why this is so significant now. And then we will have an overview of our legislative efforts regarding PERA from Mike Foote, followed by a short presentation on some of our action alerts that we have as our fossil-free PERA campaign, heading into the legislative session, all the different ways that you can get involved, whether or not you're a PERA member. And then we will have about 10 minutes at the end, hopefully, for Q&A, and then we will let you all be on your merry way and enjoy the rest of your evening. So to start out, I just want to give a huge shout out to Brett Flishman and to Boulder County for commissioning this Corporate Knights study. We would not have been able to get this study commissioned without Boulder County's help, and just want to extend a ton of gratitude to Boulder County for commissioning the study. And if Brett joins, he can give more of an introduction on why Boulder County commissioned this study and why this is so significant for municipal governments. But in the meantime, I will hand it over to Michael and Toby with Corporate Knights to give their presentation. Thanks, everyone.
Thanks, Giselle, and and thanks everyone for coming out tonight. It's a pleasure to have this opportunity. My name's Toby Heaps. I'm the CEO, co-founder of Corporate Knights, and for the last 20 years, we've been focused on trying to speed up the transition to a sustainable economy. We publish a magazine. We do a lot of research around sustainable investing, divestment, what companies are doing to invest in the cleaner future or not to invest in the cleaner future, and we do a lot of work on advocacy as well, including on divestment in Canada, US, and in Europe. Next slide. So I'm here with my colleague, Michael Yao, who oversees rankings and leads our divestment work. I'm going to, we're going to walk through what we've done. So we were invited by Giselle and with the support of Boulder County to undertake an analysis of the Public Employees Retirement Association of Colorado, the PERA fund, called PERA, to see how the fund would have fared over the past 10 years had it not invested in fossil fuel companies, and also to forecast what the implications might be for the next 10 years of not divesting from fossil fuels. So Michael, you led this project and research project. Can you just briefly describe for folks here how we undertook the analysis and what was the steps we did in the three different thresholds that we applied?
Sure, thanks, Toby. Hi, everybody. So what we did is we relied firstly on the public disclosures of the Public Employees Retirement Association of Colorado equity portfolio, which we'll call PERA for short. So public funds have to make quarterly disclosures as per the SEC rules, and we've obtained those quarterly disclosures over the past 10 years, which is equal to 40 quarters, through the S&P Capital IQ platform, and we ran the total returns for each one of those 40 quarters, so it was 10 years, under 3 different scenarios, 3 different fossil-free exclusion scenarios. So the first scenario would be to exclude from the portfolio any stock that is involved in fossil fuel activity, with at least 10% of their revenue coming from those activities. And then we ran another scenario using a different revenue threshold, this time at 50%. And then the third scenario would be any fossil fuel related stock would be excluded from the portfolio. And then we would compare each one of those three scenarios against the current portfolio of PERA and see what the difference would be in terms of the total return of the portfolio and how much money would have been lost by not divesting from those fossil fuel stocks 10 years ago. And by fossil fuel stocks, we mean those companies that are extracting, refining, burning, or transporting fossil fuel, also those utility companies that are burning coal, so thermal coal, to produce electricity. And any stock, the value of any stock that's being excluded are reinvested proportionally in the remaining stocks of other sectors, obviously.
Okay, thanks, Michael. That's helpful. Can you go to the next slide? So this slide shows, can you describe what this slide shows?
Yeah, so this is part of the main results that we came up with when we analyzed the 10 years of history. So when we exclude any fossil fuel stock that earns at least 10% of revenue from fossil fuel related activities, we find that the scenario would produce an additional 21.9% of total returns, which in itself amounts to $2.7 billion. So which means that by not divesting 10 years ago from those fossil fuel stocks that earn at least 10% revenue, the fund lost $2.7 billion. And that translates into about $4,184 per benefit recipient and member of the fund as of the latest disclosure, which is about, I think we have just under 650,000 members and benefit recipients as of 31st of December 2021. So it's a tremendous amount of money that was lost by not undertaking that strategy 10 years ago. And if we look at the other scenarios, the two other scenarios, so under this scenario, we're looking at the exclusion of companies that earn at least 50% of revenue from fossil fuel related activities. We again see a similar picture. This time we have a slightly lower extra return that the fund would have made at 21.7%, which is close to 2.7 billion again. And that's about $430,000 of lost value per member. And finally, the third scenario, here we're excluding every single stock that has any involvement in fossil fuel related activities. Again, pretty much the same picture. The fund would have lost 21.8%, or again, close to 2.7 billion. And that translates into $4,161 per benefit recipient and member. So at the end of the day, under each one of those three scenarios, we see a pretty similar picture, which means that in the market, there's a growing understanding that fossil fuel related activities is a big no-no and becoming more and more so in the market.
Can you move to thanks, Michael. Can you move to the next slide, please? So this slide sort of illustrates something that's been happening in the last year, because we often hear that if you divest from fossil fuels just out of moral or climate change concern reasons, you could be leaving money on the table. And this last year has been an example of where that indeed has happened. You can see here, if we look at the different sectors, energy stocks, and it's a misnomer, energy is the global industry classification system terminology, but it means oil and gas. And you can see that oil and gas stocks in the year prior to when we conducted our study performed quite well. They were the top performing sector by far. The stock market as a whole went down. But it's interesting. So in the context of 1 year, it's accurate to say that fossil fuel divestment was a money losing strategy. but pension funds don't invest for 1 year horizons. They invest for the long term. 10 years is a much more reasonable time horizon. So Michael, can you flip to the next slide and maybe just walk us through what we're seeing here? This is the 10-year context, and it includes this 1 year of outperformance that we saw in the energy sector. And that's really been driven by the volatility in the energy markets that's been created by the Russian invasion of Ukraine that has thrown a lot of uncertainty to energy markets. And it's short-term volatility can happen, but this picture tells us what happened in the last 10 years, including the short terms of each of the years. So Michael, do you want to maybe just walk through this one?
Yeah, totally. So as we saw in the last slide, in the past year, so 2022, the energy stocks were the lonely shining star. But over the past 10 years, even including that last year of 2022, where the energy stocks was rising, we still see that the energy sector was the laggard. They only returned 55.3% in the past 10 years, and was at the bottom of all of the 11 sectors that classifies every single company in the investable universe. On the other hand, we see the information technology sector perform the best over the past 10 years, with a total return of 435.3%, followed by healthcare, as you can see, at 309.8%, so on and so forth. So basically what happens here is, by not divesting from energy stocks and reinvesting that money into other sectors that return more, for example, the information technology sector, or even healthcare or consumer discretionary, the fund lost the opportunity of making more money from the money that was tied into the energy stocks.
And Michael, we have the question, just to clarify, how did we model these returns, and when we took the money out and we divested from the oil and gas stocks, where did that money go? I know you touched on it, but maybe just to touch on that once again.
Yeah, so they are redistributed proportionately to the other existing stocks. So if, for example, we had $100 in energy stocks, and then you have two other stocks that remain in your portfolio, one is valued at $50, the other one at valued at, let's say, $20, then that $100 that were in the energy stocks portfolio would be distributed equally. So whatever so 50, so of the 100, okay, 50 over 100 will go towards the stock that is valued at 50, and then you take 20 out of that remaining value that remained from the energy sector would go towards the other stock that's valued at $20.
So just proportionate to the value of the portfolio. So
yeah, proportionate to the market value of the
overweight
remaining stocks in the portfolio.
Yeah, okay, thanks. Can you go to the next slide? So can you tell us what we're looking at here? So
the PERA portfolio returned, as it is, without any exclusion, returned 227.6% over the past 10 years. So what this graph shows is the contribution of each and every sector towards that total of 227.6%. And again, we can see that the energy sector brought only 3.8% out of the 227.6% total return of the portfolio. At the other end of the spectrum, we see again the other sectors that we highlighted earlier on. The information technology sector returned 58.3%, healthcare at 36.9%. So essentially what we show here is the energy stocks brought almost nothing to the portfolio, just under 4%. And again, it highlights the case where, by not having the money that's currently tied to energy stocks and not redistributed to the other sectors that return more, the fund lost the opportunity of making more money.
Yeah, and I see a comment from Suzanne Plot exactly right. It's the opportunity cost of not divesting.
Precisely, yes. So here we have a more granular breakdown of a different industries. So a sector is more of a high level kind of classification system under gigs. And then under each sector, you have different industries. So on this slide, what we show are the top 15 gigs industries on the left-hand side, and also on the right-hand side, you have the bottom 15 gigs industries. And among the bottom 15, we see the two energy-related or oil and gas-related industries that are comprised into the gig sector, energy. And we saw that they're both returning less than the median of 202.4% return. So oil and gas and consumable fuels return only 83.4% over the last 10 years. The energy equipment and services companies, even worse, they lost money over the last 10 years. They had a negative return of 30.6%. At the other end of the spectrum, on the table to the left-hand side, you'll have industries that are comprised into the information technology sector, the healthcare, and some manufacturing sectors, which are all returning way above 300% over the last 10 years. So significantly above the median return among all gigs industries.
So, Michael, so this scenario that is here, this shows what we forecast, or this. Can you describe what we're seeing here?
Yeah, so it's basically an illustration of the proportion of the market value of the energy stocks in the PERA portfolio over the last 10 years. And essentially, what it says is, well, the declining value of the energy stocks is a drag to the overall value of the PERA portfolio. As you can see, 10 years ago, the energy stocks represented about 10% of the total value of the PERA portfolio. And we have three different scenarios because we are grouping companies according to the percentage of revenue that they are earning from fossil fuels. So as I mentioned earlier, we have three scenarios: 10%, 50%, and any revenue from fossil fuels. So they all started about 10% of the value of the PERA portfolio 10 years ago. But after 10 years, we see that those values have been cut by half, which essentially translates into the declining value of holding to those stocks and essentially acting as a drag to the overall value of the PERA portfolio.
And just to clarify, Michael, this decline is not driven by selling off or divesting fossil fuel stocks. It's driven by the relative value decline
of the stocks in the market. Yes.
Yeah.
Yeah.
It's interesting to see that it had dipped down quite low, like just between 2% and 3% before the Russia conflict with Ukraine spurred oil markets to
in the beginning of 2022,
yeah.
which is about here. Yeah, absolutely. So go ahead.
Yeah, so this slide is interesting. So we just like to put a caveat. This is a forecast. We used simple, clear assumptions to do this forecast. And there's a lot of different people who forecast energy markets, but I think it's relatively safe to say that there are not too many serious people in the sort of institutional investor space that expect oil and gas and fossil fuel stocks to outperform over the medium long term going forward. It's really difficult to find anybody that would go on record to say that. There are some sort of tails, but the vast majority of market watchers would not make the case that oil and gas stocks are going to outperform because they're facing a lot of headwinds, notwithstanding the short-term pressures. And so what we did to create this scenario, maybe Michael, do you want to walk through the two key assumptions that were made here, and then what it translates to if they hold over the next 10 years?
So the next 10 years, for next year, which is basically the rest of 2023, the assumption is that the high oil price will still influence the returns of fossil fuel stocks. So we're expecting 2023 to be a reflection of 2022, as the Russian conflict still goes on and there's still, tightness in the oil production market. So for 2023, we forecast that returns of stocks will be reflective of what happened in 2022 last year. However, for the remaining 9 years, so from 2024 to 2032, we expect that the tightness in the oil market will gradually ease, and any effect of the Russian-Ukraine conflict will be resolved, so that the downward trend in energy stock prices that characterized the 7 years prior to COVID in the past 10 years would resume. And so therefore, our estimate is that for the remaining 9 years of a 10-year forecast period, the return would be equal to the annualized return of the 7 years prior to COVID, so essentially 2012 to 2019. So putting those two assumptions together, with the starting point which is November 2022, and we start with the current portfolio of called PERA without any exclusions, so the current composition of its portfolio, and then applying the forecast scenario where we exclude stocks which earn at least 10% of revenue from fossil fuel, which we found earlier was the scenario that produced the most return. We estimate that the fund would lose out on up to an amount of 6.4 billion by not divesting now from fossil fuels, which is about a 32% extra return. So the cost of not acting is pretty steep.
Okay, thanks, Michael. I think that paints a pretty clear picture. I see there's a question: is that 10% threshold of revenue or generation, is that considered fossil free? I think the threshold, 5 or 6 years ago, people were using thresholds like 30% or 20%. I think 10% now is in the sort of mainstream of aggressive divestment, but it's getting ratcheted down, and in 5 years' time, probably 5% or less will be in the sort of mainstream of definitions of what constitutes fossil free.
Yeah, totally. And we saw under each one of those three scenarios, the differences are very minor, which again means that the market is going into the direction of fossil fuel or no fossil fuel, and nothing in between.
Okay. So happy to take questions, and back in Giselle, Mike, any questions that you have, or anything else that we can cover? Happy to take your direction.
So it looks like we have a couple hands raised, and we had a lot of very engaging questions in the chat as well. So maybe we'll take just a few questions now. We have this presentation scheduled until around 6:10. So we could do 10 minutes of Q&A now, and then we'll switch over to a statement from Boulder County about the importance of this study and why it was commissioned, followed by a statement from Mike Foote about some of the legislation that's happening here in Colorado, and then followed by some action alerts. So Mike, your hand is raised. You can go first.
Okay, thank you very much, Giselle, and thanks for this presentation, Toby and Michael. Really appreciate it. I wanted to see if you could clarify for me, not having a financial background, that what is your baseline that you're measuring against again when you get this decrease in this opportunity cost, $2.7 billion over the last 10 years? Is it like the S&P 500, or I mean, like, what is the baseline? I guess I think you were explaining it, but it might have gone over my head.
Yeah, so we've done a number of these analysis, and we find that it's most compelling if we can use the exact same holdings that the fund actually has, the real holdings. So we're using the real holdings the fund has, and we're just reallocating the money that you would get from selling the fossil fuel stocks proportionally into the existing stocks that the fund already owns. There are other ways you can do this too. You could say, well, what if we divested from the fossil fuel stocks and we invested in, say, green stocks? We didn't do that. That's because that way that can be sort of challenged, and this way it's really hard to challenge, because if we didn't, it's the lowest intervention sort of way of divesting from fossil fuels. It's just to divest and then allocate that money proportionally to the remaining stocks. And so it's just purely playing with the stocks the fund already owns.
Okay, so just putting it in kind of simplistic terms for my own brain, it's like if you have 10 stocks, one of them is a fossil fuel stock, you would just take that out and kind of distribute it to the other 9 stocks in the portfolio.
Exactly.
Okay, thank you.
And then Ruth, if your hand is raised, you can go next.
Thanks. I was just wondering, so what is the rationale, or maybe it's not a rationale, but what are we up against as far as people saying, no, we need to keep investing in fossil fuel? What is that impetus? Why would somebody, I mean, why are people still investing in fossil fuels with PERA?
Yeah, it's I think it has a lot to do with status quo, and it has a lot to do with letting other people, investment managers don't like other people telling them how to do their job. And the arguments, they don't make that argument, but I think that's the root of it. But the arguments they'll make, the first one they will make now is oil and gas stocks were the best performing stocks the last year. We would have hurt Colorado pensioners if we had not been invested in those stocks. And that's true, but it's also true that we hurt the Colorado pensioners more by investing in those stocks over the last 10 years. And there's a strong body of evidence to suggest that they'll be hurt even more over the next 10 years if we continue doing what we did over the last 10 years. There's more technical arguments they make, but I think I would think that would be the first one they would make. And we'd be happy to share a brief we did when we worked with the government of Ireland on their divestment a few years ago. And there was sort of 4 or 5 kind of key arguments that usually come up. We'd be happy to sort of share those with Giselle after this, and with how you refute them.
So then when making these arguments and presentations to the PERA investors, we somehow then would need to be very mindful that they don't want to be told what to do, and somehow present it in a, I don't know how to do that, but I'm just wondering, and I'm wondering how would you do that? But that's more of a rhetorical, because I'm sure other people have other questions.
Yeah, and it's a really good question, and I imagine Mike will be encountering this as well. We often hear there's this thing, fiduciary responsibility, where pension funds say we have a legal obligation to look out for the financial returns, and there's different ways of wording that for different funds, but it's usually present, and I imagine it's usually fairly narrowly interpreted. And so it's true that the impetus of 350, and a lot of people on this call, may be not purely financial. That's part of it, but it might be more motivated by climate change. But putting that aside for a moment, groupthink is something that's prevalent in all institutions, including investment management. And sometimes something like this that recognizes a system change happening. It can intervene in incrementalist processes and help this to protect a lot of value. So there's sort of a behavioral argument.
Thank you so much, Ruth, for that question. And thank you so much, Toby, for those answers. Ryan, your hand is raised.
Hey, yeah, thank you. Thanks for the presentation. It looks like it was a fun and interesting investigation. I have a few questions, and I understand we have limited time, of course. So maybe I'll just start with a simple one, and if there's any time left, include a second. This isn't so much a problem with your analysis as it is maybe just the presentation. I think I was just confused. You were showing something like a $2 billion discrepancy over a $22 billion total and calling it 20% more or less. My mind is telling me that's more like a 10% difference. Am I misunderstanding something?
Sure, Michael, do you I think it's based on the value of the pension fund. That return is multiplied by the value of the pension fund. So do you want to maybe just chime in there, Michael?
Yeah, are you referring to, I guess you're referring to that slide, Ryan?
Yeah.
Yeah, so the percentage is not the difference between those 2 points, it's over 10 years. So that's why you see a discrepancy between, I guess, the numbers that you're referring to.
Okay. I'll take your word for that. I'm not completely sure I understand, but that's okay.
No,
I think I just wanted to maybe point to something that make sure you guys have.
No, it's a good point, Ryan.
Made a typo. Yeah.
Yeah, no, it's correct. But I think what we should include is we should include all the numbers that we use for the math. So to get there, you need to know what the sort of starting value of the pension fund was 10 years ago. And so we have that in the spreadsheets for this, but it wouldn't hurt to include it as a little note on the slide because people will like to do the math themselves too. So that's a good.
So what you're missing here is the starting value here. The starting value at that 23rd of November 2012. And that's.
So these are both just normalized to their respective value on the start date. So they look the same.
Yeah. So basically we're trying to show two things on one same graph, one being so the percentage return over 10 years, but also we used the dollar value because it hits the note more easily by having people to see the dollar value that's being lost as opposed to just a pure percentage. So what we could have shown is instead of having those dollar values, is to show the percentages, but we prefer to show the dollars to hone the point home that, well, we're losing 2.7 billion. But yeah, to answer your question, we would have shown the dollar value here, then you would have shown the dollar value here, or the percentage here at the beginning, and then the percentage at the end. Then you would see that the math does work.
Okay, thanks. Can I ask one more quick one?
Yeah, one more quick question, and then John, I see that your hand is raised. I think after Ryan's question, we're going to move on to the rest of the presentation, but then we'll have an additional 10 minutes at the end to address additional questions, and we will get to the questions in the chat as well. So yeah, Ryan, you can ask the next question.
Okay, so that was it to go. Yeah, I guess this is just me curious to see how this would look over other 10-year time frames. You guys pointed out that some of these results are sort of specific to 1-year timeframes versus 10-year timeframes, but what about 10-year timeframes spanning different parts of this past century? I don't suspect that you have an answer on the top of your head right now, but I'd be curious to see how that works out. Maybe this last 10 years was sort of a exemplary, well, non-exemplary scenario or something.
Yeah, I think we did run a 10-year back in 2015, the first time we did this analysis, and we found similar results. I think they've become more pronounced though, but it was the similar headline: you lost money by not divesting. But the things that are happening now is that the electrification of transport is, about close to 40% of all the end use of oil and gas, or oil goes to oil and gas. I mean, goes to transport. And transport's being really disrupted by the electrification, and so there's already sort of over 1 million barrels of oil that's coming out of demand because of electric cars, and every year that's going up geometrically. So the disruption we're going to see to oil markets that's going to be driven by electrification transportation, that was not a facet of the last 10 years as much as it will be the next 10 years. We'll see, but it's interesting, notwithstanding that the same story holds over the previous 10-year period as well. It's just not quite as wide of a difference.
Okay, thanks.
Thank you so much. So for now, I'm going to close the Q&A for this portion, but again, we'll be coming back to another Q&A session after this, the rest of the presentation. So I'm going to move us along to a short statement from Brett Fleischman. Again, thank you so much, Brett, and thank you so much to Boulder County's Office of Sustainability, Climate Action, and Resiliency for commissioning the study. And yeah, just anything you want to say about why you guys commissioned the study and why you think it's important.
All right. Well, thank you for having me, 350 Colorado. I really appreciate it. Hi, everyone. I'm Brett. I'm the Senior Climate Strategist for Boulder County's Office of Sustainability, Climate Action, Resilience, OSCAR. And yeah, I want to say I really appreciated that last back and forth. And I was thinking when you all at Corporate Nights did your forecast, I was like, hey, guess what? Boulder County has a projection of 30% new registered electric vehicles in Boulder County by 2030, but we're going for 50% with our incentives and education and things like that. Germany this year registered 30%, or not registered, 30% of their car sales this year were EVs. It's the decade that you picked for your forecast was super kind to the oil industry and extremely conservative based on where we're going. We see like massive climate action in the next well, I keep thinking of it as 5 years, but from here to 2030 is a sprint for local governments across the nation. And we were just all juiced up by the IRA, and we're going for it, y'all. And I can't imagine these numbers looking good anymore for fossil fuel companies. I guess with the exception of these blips here and there. And it's irresponsible for PERA, my pension system now, to continue to be invested in fossil fuels with a financial argument, which wasn't always true. And it's morally bankrupt for our large institutional investors, especially public institutional investors, to ignore this issue. So we want to do our part from the local government perspective. We're excited to work with our representatives in the State House to advance this dialogue in like meaningful and data-driven ways, and we're committed to pushing for a fossil-free PERA. So thank you all for hosting this. Thank you all for the work that you've been doing to advance fossil-freeness everywhere, and we look forward to pushing forward alongside you. Thank you.
Thank you so much, Brett, and thank you so much again to Boulder County OSCAR for helping to commission this study, and thank you so much again to Corporate Nights for doing the study. Now I will turn it over to Mike Foote to give an overview of some of our very exciting legislative efforts. For those of you who don't know or aren't following, the Colorado legislative session just started, and we do have some exciting legislative efforts regarding PERA. So I will hand it over to you, Mike.
Okay, thanks very much, Giselle. Thanks for all of you for being here. And I'm going to take just a couple minutes to go over the legislative landscape, but some of it is a repeat of the answers to Ruth's question, actually, but I'll maybe go into a little more detail. But just for a little background, I was in the State House for 6 years and in the State Senate for 2 years. My last year was in 2020. During the time in the State House, I was on the House Finance Committee, which would be the committee or the Senate Finance Committee that would hear this particular bill probably. So I have a little bit of familiarity, particularly with PERA and their presentations, even though I don't have a financial background. But the legislators that are on those committees, many of them are the same. They don't have a financial background, but certainly they have a policy perspective and hear from constituents about what should be done with things like PERA or other state financial issues. So this bill has been run twice before. It has not passed the other 2 times that it's been run. The most recent time it was run was in 2021. And it was started in the House and did not pass its first committee. Despite the common sense arguments and despite the fact that divestment would clearly help the planet, and that's why we're here doing what we're doing, still it faces a battle in the legislature. And the main reasons are, I think it was touched on before, many people, so it's human nature, many people are like this, but legislators are like this too. Oftentimes the status quo is easier than change. And when there is change, again, just like most normal people, legislators prefer incremental change, not wholesale change. And so you have to overcome the human nature in order to pass big changes in any kind of policy area, not just this kind of policy area. But you just have to keep that in mind, I think, when we're doing legislative work, that you're going against institutional status quo. And in order to move the needle there, that takes work, and it's not automatic, even if you have the best arguments, which in this case we do clearly. But at any rate, what we have seen in the past has been, I think Toby actually said this, and it's true. The PERA representatives would come in and say, we would end up losing opportunity cost money if we were ordered to divest. We're the experts. We should be allowed to do what we do without interference from the legislature. I mean, they don't say it that way, but that's what they're saying. In other words, they're saying, without saying it this way, don't tell us what to do. We're the experts, you're not, and leave it to us. And then when a bill like this gets introduced, they have a big network, of course, of PERA recipients in the state. I think it's over 100,000. And many of those folks are rightfully concerned about their pension and being able to make ends meet in their retiree years. And so the message they get is, if the legislature messes with our pension, then there's a good chance that we could have less of a pension. And they don't want that. And so it's sometimes a pretty simplistic message that gets out, but I think everyone on this call knows that in politics, sometimes that's the message that sticks. So that's something that needs to be overcome. It's not that it couldn't be overcome, but it does need to be overcome. And I think actually this report is one important step to overcome that, because we have a pretty straightforward message of our own, which is that if divestment would have occurred 10 years ago, then PERA would have had $2.7 billion more in the bank. But it didn't happen. We can rectify that now. And so that 10 years from now, we're not looking back at billions of more dollars that were lost out on. But it takes work, and it takes organization, and it takes help from people like yourselves, making sure that you have one-on-one conversations with your legislators about how this is important. And they will listen to their constituents and take that into consideration. Certainly, the PERA recipients, at least those that would be against this, will be contacting their legislators. And so PERA recipients and others that are for this would need to be contacting their legislators at some point. We don't have a bill yet. There's still discussion about how best to introduce the bill and which legislators are going to introduce the bill. But we expect that those will be resolved sometime in the near future, and we will go at it again. So I think this report, as I said, is quite helpful. And I think that we can make a good faith effort to go forward and see what we can do. It's going to take all yours help and others. So please keep that in mind as we go through. And I'm sure Giselle and others will be able to keep you notified as to what the steps are and how you can be most effective in making your voice heard with the state legislature. So thanks for the time. And of course, I'm happy to discuss further or answer any questions specifically as they relate to the legislature.
Thank you so much, Mike, and thank you so much for all you're doing with the legislature to help move these bill concepts forward. All right, I'm gonna wrap us up here in the presentation by sharing some slides on how you can take action. Everyone here has a really powerful voice and can help move this forward and hopefully, get us to the end goal that we all want, which is to get PERA to divest from fossil fuels. So I'm going to share my screen just super quickly and go over the fossil-free PERA campaign, what our efforts are here at 350 Colorado, and what you can do to get involved. So I'm going to share my screen now. 2 seconds. Okay, so 2023 fossil-free PERA action alerts and ways to get involved. There's a lot to go over. I will try and go over it quickly. I will also be linking this slide deck into the chat right after. So if you miss a bunch of stuff, because I'm going to go over super quickly, you can find all the links and all the information afterwards. So to start out, I am the head of the 350 Colorado Fossil-Free PERA Defund Climate Disaster Committee. So if you are interested in getting more involved in defunding climate disaster work, so all of our divestment campaigns here in Colorado, you can reach out to me directly. I am happy to do a one-on-one meeting. I'm happy to answer any questions you have over email. And I really, really would love your help. We have some big plans underway this year for our fossil-free PERA and defunding climate disaster campaigns. And if you are interested in getting involved, you can join our 350 Colorado Defunding Climate Disaster Committee if you haven't already. And that's just a way to stay up to date on all of our divestment related updates and action alerts in our various defunding climate disaster campaigns. If you're more interested in only fossil-free PERA specifically, you can join the Fossil-Free PERA Committee to receive PERA specific action alerts and updates. There's no harm in joining both. Lots of people are in both committees. And this is the first Defund Climate Disaster Committee meeting of the year. We'll be hosting these meetings monthly on the second Thursday of each month. I'm hoping that in future months we will have similar presentations on different divestment related topics. I am so grateful that we started the year out with such an awesome presentation by Corporate Knights. So if you're interested, that is the second Thursday of each month. And one of our major calls to action is to sign and share the fossil-free PERA petition. This is a petition that's created by 350 Colorado. It's already gotten a lot of signatures, and it calls on PERA to divest from fossil fuels and reinvest in a clean energy future. So we are trying to get as many signatures as we possibly can heading into the legislative session. So please sign if you haven't already and share it with your networks. And if you would like to go the extra mile and help to gather signatures, if you could commit to help gather signatures, put your name in the chat, let me know that you'd like to help with this, and I will follow up. And yeah, once you have the slides, you can click here to sign it and share it. Mike went over our legislative efforts, just to give a little more detail on the two legislative topics that we're moving forward this year. The first is SB 23-016, Greenhouse Gas Emission Reduction Measures, which is introduced by Senator Hansen, Representative McCormick, and Representative Sirota. And this bill has 14 sections with a variety of measures to reduce greenhouse gas emissions in Colorado. For our purposes here, although you can read in the bullet points an overview of the full, it does a lot. It's a really awesome bill. But regarding PERA, it will require the PERA board to adopt proxy voting procedures that ensure that PERA's votes as shareholders in the companies they invest in align with and support statewide gas emission reduction goals. And it also requires PERA to publicly report a description of climate-related investment risks, impacts, and strategies. It will also require insurance companies to complete an insurer climate risk disclosure survey. And very exciting, it'll strengthen Colorado's greenhouse gas reduction targets to 100% instead of 90% by 2050, with interim goals to help keep us on track. And there's additional stuff here. You can click to see the full bill here, and I created a bill fact sheet that you can share with your networks, share with your legislators, and make sure we get this bill passed because it's really exciting. Our other bill concept is the PERA divestment bill that Mike mentioned. We are currently in conversation with legislators about introducing this bill in 2023. Mike already gave some background on it. Basically, the bill would require PERA to identify their fossil fuel investments in their portfolio and make a plan to exclude those companies from their portfolio and transition their funds out of fossil fuels and into alternatives in a way that protects PERA members. But as we're seeing today, by divesting from fossil fuels, you're already protecting PERA members. So next steps for 2023 and what you can do. So we're still looking for a legislator to be the primary sponsor on this bill, although we do have potential co-prime sponsors currently. So if you have a relationship with your legislator, or if you'd like to build a relationship with your legislator, reach out and just let them know that you support PERA divestment and you would love to see them support this bill. And we do have a bill fact sheet as well for this bill concept. If you would like to support our legislative efforts, you can join the Fossil-Free PERA lobbying team to testify in favor of climate risk assessment and fossil fuel divestment, and also let your legislators know that you support these bills. And you can email me at giselle@350colorado.org to be added to the lobbying team list. And if you are a PERA member, you don't need to be a PERA member in order to support this effort, obviously, but if you are a PERA member, your voice as a PERA member is especially powerful on this issue. So please consider testifying in support of these bills and also reach out to other PERA members just to spread the word. One of our major efforts this year and heading into this legislative session is having conversations with labor and unions. If you are connected with Colorado labor unions, or if you are yourself a union member, we are working to set up meetings with union representatives and leadership to discuss the risks of PERA fossil fuel investments and the way that these investments harm PERA members. So if you are connected to labor and unions in any way, please reach out to me if you have any leads, and I would love to get in touch with any contacts that you have. And we do have a lot of conversations underway. One exciting call to action, calling all PERA members. So we just recently found out that 4 PERA board seats are open for election in 2023. So as a PERA board member, you can have a lot of power in terms of amplifying the call for fossil fuel divestment and also supporting policies to ensure that PERA's shareholder votes align with a fossil-free future. So applications are being accepted now through March 1st. If you are a PERA member and you qualify for board election, you can click here to learn more. And we are hoping to get some climate champions on the PERA board because that is very needed. And lastly, share the Corporate Knights report. Keep an eye out for a follow-up email from me in the next few days where I will be sending the finalized version of the Corporate Knights report in addition to a promotional toolkit. I'll also be sending out a recording of this meeting to everyone in attendance, and we really need all the help we can get to just share this report far and wide with your networks, with other PERA members, with your legislators. Just shout it from the rooftops. PERA has lost $2.7 billion by not divesting from fossil fuels in the last 10 years. And that works out to over $4,000 per PERA member. And that's all I have. Thank you for your support. I'm going to stop sharing my screen now. Unfortunately, we are at 6:30, but I'm wondering, since we did say we would do a Q&A session, if we could just do a short Q&A session for those who are willing to stick around, and for those who have to hop off at 6:30. Thank you so much for being here, and I hope to see you taking action on PERA. Thank you so much. Do we have any last questions? Andrew.
Hello, this might be a question for somebody that's a little bit more familiar with Colorado's fiscal situation over the past 10 years, but is it within the realm of possibility that if we divested 10 years ago that state employees and municipal employees that contribute to PERA wouldn't have been asked to increase their contributions to PERA like they had in the past? Because I know when I first started as a state employee, I got a raise, but then over half of the raise was taken away because I had to increase my contributions to PERA.
So I can take a stab at that, although I don't have the numbers at all at my fingertips. But you probably are aware, since you're a PERA member, that the legislature has had to step in and firm up PERA over the last several years. There were a couple major bills, at least one major bill passed, I think in 2018, maybe 2017, that included a substantial legislative contribution every year out of the general fund to PERA to make sure, again, that it was solvent, that it was fulfilling the promises that it made to retirees, but also included, as you noted, additional contributions from retirees and also people that are yet to be retired. So that's happened in the legislature. There's been bills passed. It would be interesting, though, and I'm not sure if we could do this calculation or Corporate Knights could do it. It'd be interesting, though, to go back and know exactly what those numbers are as far as what the legislative, particularly the legislative contribution, that can be found out relatively quickly and easily, and maybe do some kind of calculation as to whether or not that would even be needed if there were divestment from fossil fuels 10 years ago. And the reason why I mentioned the legislative contribution is because, number one, it's fairly easy to find out what the legislature contributes. And number two, that money comes out of the general fund. So that is opportunity cost lost for things like K-12 education, higher education, and other general fund type of expenses. And so that would be an interesting, I think, argument that could be used if we could nail down those numbers. So thanks, Andrew. And hopefully I sort of answered your question.
Thanks so much, Mike. Do we have any other questions before we jump off? Just raise your hand if you have a lingering question that wasn't already answered. Maybe we'll take like one more because we do want to be mindful of people's time. And I do apologize for going over. But yeah, we'll take one more question. It looks like Chelsea, you have a question. And just quickly, I did save the chat. So I do have all the questions that you entered in the chat. I'll work on trying to get some of them answered and making sure to follow up with everyone. Yeah, Chelsea.
This is Braden via Chelsea's computer and hanging out. One of the things I thought of as like a potential pushback or a conversation to navigate is like scenarios regarding a potential recession. And I'm just curious on if there was a scenario ran using maybe like past recession data, and if scenarios like that support the arguments and our ability to convince people.
Yeah, that's interesting. Thanks for asking that question. I guess 2020 was in itself a little bit of a recession that was embedded in the scenario that we saw in the analysis of the portfolio's behavior. We can see, for example, at the beginning of 2020, the oil stocks values just plunged vertically before recovering, as well as the other stocks in the market. So it's usually the case at the beginning of a recession that things go sour very quickly and then tend to recover. But the oil sector tends to recover less quickly than the other sectors, as we found in 2020. It's really the intervention of the Russian-Ukraine conflict that kicked the values of oil stocks tremendously last year, especially from February 2022 when things started. So the recession itself, if anything, has a negative impact on oil stocks because of reduced economic activity. But other than that, it gradually returns back to what it was before that is the downward trend that we see over the past 10 years in oil stocks.
Thank you.
Thank you.
Thank you so much. And with that, I will close our meeting. Thank you so much, everyone who stayed additional time. I know time is precious, and I am so grateful that you chose to spend it here. So thank you so much. I hope to see some or all of you at the legislature. Feel free to reach out to me. It's Giselle@350colorado.org if you have any follow-up questions. And keep a lookout for an email from me in the next few days where you will get a recording of this meeting. You will get the final Corporate Knights presentation and a bunch of other action alerts. So thank you.